Test. Yeah. Okay, traders, what's going on? Jamie Saettele here. It is day before Thanksgiving here in the U.S., November 23rd, 2016, 12 o'clock in New York, 1 o'clock, or 11 o'clock, sorry, in St. Louis. And what better way to start this midweek webinar with a chart of some U.S. dollar indices. Eileen says, what's going on? She says, happy Wednesday, and thanks too for your help with Mike this morning. Of course, Eileen, we are a team here. So looking at the US dollar index, we haven't actually looked at this one in a bit. You're looking here at the US dollars, the FXCM index. So this is the equal weights between Aussie, Euro, Pound, and Yen. And do you remember this is really the line you want to pay attention to in the event that we do get any sort of pullback in the dollar. And there are reasons to suspect that we will, and I'll go through that here in a minute. But this long-term former support, turn resistance, really the breakout through it, that if we're going to end up really going into some massive, insane dollar blow-off, like some suspect or say that we may, then this area, which is also intersects with the high back here from 2016 in January, is going to end up being, your support now. And that's about 12,300 in this index. So, 120 points higher or lower than the current level in this index, which fits pretty nicely, I think, with the idea of the euro getting a bounce as per the test and post that I put out on Sunday. If you recall the extreme rates of change and just the levels that we're getting into. So keep an eye on this. And here's another very interesting observation, at least from my vantage point here. If you just draw a line off of the April high from 2015 and then the January high from this year, it comes in just a few ticks above where today's high is. Okay, so today's high is 12,440, and we've got 12,455, 60 in this index where that line registers. Okay, now I bring this up because I don't have a good history, obviously, on this index because it's fairly new. It's only a couple years old. But if we look at DXY, we had very similar setups as far as at least a near-term top was concerned several other times in history, okay, where you kind of can draw, an upward sloping trend line. One was back in the late 90s, okay? You can see that one there. Similar. Another one, which is more similar to today, is this one back in the top that went into 1994. All right. In both of those, it was eventually, interim tops. In the case of 1994, is a pretty big one before you went higher. But here we are now, okay, on the dollar index, and we've obviously talked about and showed this slope line. Crosses through here. Obviously, you'd like to see the week, if you're actually going to get a decent pullback or even a reversal, you'd like to see the week close under this, this line that extends off the high from March of 2015. But there's another big level here too. It's the 618 retracement of the entire decline from 2001, okay, to 2008. So that's a massive, massive, important technical level to pay attention to. Slicing right through it on the upside on the first attempt, to me, would be more of a surprise than if it really, kind of pulled back sharply. And if you're, tactically speaking here, looking at this dollar index, this really is the chart to pay attention to on the daily. So you have your weekly resistance 618, these lines here, which extend basically former channel resistance levels. Those are going to be your supports, and they already have been supports actually several times. Canwall, what's up, my man? How are you? Asking about pound yen. I will certainly get into pound yen, and just give me a moment here to kind of go through the prepared remarks, if you will, on dollar. I want to look at gold. I want to look at euro. I want to look at dollar yen. And kind of take stock of what the big dollar majors are doing in the index. So this is resistance here. Okay, in my opinion, you can't really be, at least especially with euro and yen. It's very difficult for me to be bullish dollar against those things into this level. Okay, this long-term 618. You've also got euro and yen at their own respective levels, which we'll get to. But a pullback here in those two currencies, remember, they make up, 80% or something, I believe, of, or is it 70% of the index? Yen's 13%, I believe. Euro's about 57. So it's a big portion of this index. So pullback in this region, giving us where we are right now, 101.66. Let's say that you can get down into even the former high from, incidentally, last December 2nd. If you recall, we were going into a high actually at this point last year as well. Let's just say that you get down to 100 spot 50. Okay, so let's just do a little fun math here. So if you go down to back to 150, currently 101.65 minus 100.51. Okay, that's 1.14 dollar index points. From the current level, that is 1.1%. So if we take the spot rate right now of euro, 1.0555 or so. That would get you about 106.75 in euro on an initial, kind of an initial thought as resistance. And for dollar yen, current spot being 112.60, that would get you about 111.33. All right, so kind of keep those levels in mind, but really just keep this chart front and center. This would be the area for support. If you're going to pull back and you're going to continue higher, thereafter, this is it. All right. The lower bound for this would probably be not all the way down at 99.83. You could even say 100 or so because of this line. So that's really where, my general focus is on the dollar. Keep it simple here. In summary, at a massive resistance point, and even a minor reaction from this level probably gets you down back to 100 to 100 spot 50, which gets you to 106.75, 107 plus in euro, and probably 110.50 to 111.30 in dollar yen. So let's move on then to euro. Okay, so here's euro. All right, scrolling back, the long-term stuff always does seem to clarify. When you're looking at hourly charts, moves like this kind of get panicky, and to be honest, it does you no good. So if we draw the long-term resistance line, obviously the median line, insane on the election, resistance literally to the tick, and 700 pips later, 10 days later, 11 days later, here we are, and we're getting on into the first parallel that you really want to see for support, right? So that puts you, more or less here. You could, 105, look, in the grand scheme of things, we're 105.50. 105 would be, your spot. That's more or less the low from last December. Some platforms have it a little different, again, because that was, the ECB spike. So you didn't have, kind of a uniform price. But, for some platforms, it's like 105.17. For one, it's 105.38. For this one, it's even 105.50. So, for all intents and purposes, we are there. Okay, so what you want to see, and this is where trade tactics come into play, as I noted on Twitter just a moment ago, what you end up getting, we had that high volume level in several currencies, notably in euro, Swiss franc, and Japanese yen. And that was the 9 o'clock hour in New York. All right, that was after the durable goods number came out and all the economic data came out at 8:30 New York time. And you have a high volume level there of on spot. It is right here, so it would be 105.56. So that's exactly where we're trading right now. Okay, so using this kind of method, if you will, as a reference point, will keep you from doing something really dumb, like trying to pick the low tick of a move or top tick of a move. So what you do here is you wait for the market to settle up through this level at 105.56. It at least gives you a completely objective reference point for potentially putting on a long position. All right. So let's say that we can get back up into, and with the euro, it's everything seems nuts, but we're really not that far from where we opened the week, right? The yen's the big story here. 105.90 is where we opened the week. If we can get up into 105.90, it kind of shows some strength in the euro here off of this long-term support that I just showed. Then you would actually have the option of buying back into 105.56, which was your high volume level from today, and you'd put a stop basically under 105. 50 pips of risk for what could be a recovery back into 107 plus. Okay, that would be kind of the anatomy of a setup right there, and kind of trading a turn like this for euro. Dollar yen, similar story, similar idea. If we look at the dollar yen bigger picture chart, I actually do have a substantial level up here, believe it or not. So this is a daily chart. Let's go to the weekly. You can see it a little easier where this comes from. So here we have the 1990-1998 trend line on log scale. It literally top ticked the move in 2015. Some of you might remember that, and we had called at the time for a move back to 100, which seems stupid at the time, but actually happened because grand scheme of things, we were looking at this being wave A up, wave B down. I actually believe this is probably wave A of B. So this means this rally, a lot of this rally is going to end up being retraced eventually. You could end up being A, B, go down to C. Even if that's the case, you could get up into 115, which is the former base. But let's deal with the near term. We'll worry about that stuff later. So here are various slope lines, okay, based on this 1990-1998 trend line. All right. A parallel that extends off the 2002 line comes in as good support here in 2014 in about this time of year in December. That was on the way up. Last year, when we broke that level, that line was really resistance for the resumption lower, right? We consolidated around it. It acted as resistance for 1, 2, 3, 4 weeks before you went lower. And now we're getting back into it. So if we zoom in on the daily, see really where this line comes in, you can see that, we're more or less there. It's pretty much 113, right? I think today's high is 112.99 or something. What is it? 112.98, right? 97 and 0.8 of a pip. So you more or less are pressing into this massive, spot for dollar yen, 113. Now, this is all fine and dandy, Jamie. There's nice long-term lines up here, but let's be honest, there's some sort of subjectivity to this. So what about some objective data that we can say, man, this move is really overdone, this move is nuts, and we're due for a snapback or something, something else besides a parabolic move? Okay, well, I'm glad you asked. Let's take a look. We'll look at two things. Okay, the middle indicator here is showing you a 20-day range size, right? Now, we've talked about this earlier this year because we had a preponderance of extremely low 20-day ranges and 60-day ranges, even 52-week ranges. In other words, the market was, extremely coiled. And we talked about the potential for the big breakouts happen kind of in a sinister fashion, right? Because you got the move after the election, and then everything reversed, and it really hasn't stopped since then. Very minor reactions along the way. In the case of dollar yen, really hasn't been any reaction. But this 20-day reading of a range size, again, so you're looking at high to low, and I'm looking at closes, okay? High to low close is 9.46. Now, if we were looking at high to low, then it'd actually be even bigger because obviously you had the post-election spike, which is not included in this. So that reading, if we go back and we look at points at which you had a 20-day range of that magnitude, and this is Japanese yen futures, okay? So it's going to be the inverse of dollar yen, okay? The reason to look at it this way, we can look at it in dollar yen with this, but the next indicator it's difficult to look at because you're looking at basically a VIX formula, which will, not really take into account upside moves rather than downside panic moves. In Japanese yen, that's how you want to look at it. So 20-day range size when yen's going down, we have really the only other times back in 2 years ago at this exact time. In fact, November 20th was a low at that point, and you did have a period of consolidation and a move. In the case of dollar yen, it was about a 200 point move. If we look at it with dollar yen here, I'll do the same thing, and we'll look at range size show me. We'll look at this being 8.5%. Okay, so you can see we actually had it Brexit, ended up being the low. We had it today. We had it back in that November period of 2014. Okay, so you ended up getting, somewhat of a pullback and then some sideways trade. In the case of pullback, you went 118.90 down to 117.30. So, there was a decent counter trend move at that point. After that, there's not, a whole lot. You've got June 2013, which was a low. Again, these are trying to look at extreme moves, which may tend to revert to the mean a bit. All right. And then after that, you've really got to go back to the financial crisis, okay, and some of the big mean reversions that you had at that point. So you can see that this does tend to identify objectively, of course, what I would term extreme movements, which are prone to snapping back, all right? And we really haven't seen it. You really have to start with the financial crisis. Before then, there's really nothing of note. I'm going all the way back here 30 plus years. Okay, you can look back since the financial crisis. We've had some instances. Back then, you've got to go to 1998, and most of them are the opposite. Most of them are not when dollar yen's going higher. Most of them are when dollar yen's going down, which makes sense because that's typically more of a panic type market. In this case, it's almost the reverse. You are seeing a panic type move in Japanese yen, but on the other side, as you're seeing rates just go through the roof here in the US. So let's go back to the other indicator. The other one, which is the top one, again, this is the Williams VIX fix. It's a simple formula that was derived by Larry Williams. He's a famous kind of trader, educator guy. In fact, his daughter is actually a famous actress. She was married to Heath Ledger, and then he died. But here we have range size show W. Okay, here we go. So 20, we're going to do for everything over 10.4. All right, so we have today. Okay. How extreme is this move in dollar yen? Well, we've actually never seen anything like it. So let's lower the threshold. Let's just go to 10. The only other time that we saw anything like this was actually back here in February and March of 2009. Okay. And in that case, if you remember back in February and March of 2009, dollar yen, again, this is yen futures, dollar yen actually plummeted in the ensuing several weeks. So let's go back to, that would have been right here. Nope, that would not have been there. That would have been right here. Okay. So you would have gotten a top in dollar yen, 99.60s, and you would have fallen 600 points in the next 2 weeks. So we do have these beautiful looking slope lines that have been drawn based on the 1990 to 1998 level, but from an objective standpoint, from studies like this, yeah, dollar yen is overdone. Can it go up another 100 pips? Sure it can. But do I think that the next 300-400 pips is lower? I actually do, based on these two studies. All right. So with that, armed with that information and that knowledge, how do we want to trade this? You could go short and pray to the gods that it works. It's probably not the best idea though. So we're going to go to the volume levels. And again, here's the euro chart we just looked at. Here's the yen chart. Yen futures, your high volume level, again, from that same time, of course, which is this morning after the durable goods number. Keep this in perspective. This is the highest volume since just after the election. You see all these high volume levels here at the election. All right, so, you know, kind of extreme emotion, that's what volume tells you, right? Extreme emotion on one side, reverse, extreme emotion on the other side. Eileen asking, is your volume indicator the same one on FXCM Market Scope? It is not. This is because what this is showing here is futures volume, okay, rather than FXCM volume. But I can tell you, I still do have a view of the volume indicator, you know, on FXCM, and you can see just by looking at that volume that the volume was extreme on the top side, right, this morning in dollar yen. In fact, I looked back for a number of years, and I couldn't find an hour that had volume that high on FXCM's platform. So it does fit the bill as far as some sort of washout, if you will. So anyway, let's look at this. Yes, absolutely, Eileen. The FXCM one can definitely be useful. There's no doubt about that. So let's look at the volume, the spot price. And the spot price, the close of that hour, is 112.06. Okay. So how to play it? Well, 112.06. You want to be below there. That's more or less your, saying it's okay to try to trade the short side on dollar yen. Moving forward. Until then, you have to respect potential for this thing to continue, to just go nuts on the upside. Eileen asking, have I written anything about volume? Let's see. Have I written anything about volume that we can access here? Let's see. Let's look at, do I have anything on resources here? I don't think I have anything specific on volume here. Probably worth adding something as a reference. So we'll take a look at doing something like that. But just moving forward here over the next, couple of days, know that your high volume level is that bar, the 8 o'clock or 9 o'clock bar New York time, 112.06. So below there signals, basically a reversal based on this analysis, and at which point it'd be okay to attempt a short position. Okay, so those are the big things, obviously, to look at right here. for dollar and the two biggest components, yen and euro. What about related markets like say gold, right? Well, it looks at this point, having broken decisively 1200, we're $10 below it. It's back to the median line from the really long-term slope line, right? Which is back to 2011, 2012 trend line. That level has been significant, right, for years. I mean, it's resistance, breakout through it, support, breakdown through it, revisited this year, breakout through it in February, and now we're back, to levels that were seen in February. And you have to look to this median line now for support, and that's not until 12 or 1120 actually is right where it comes in. So that would be your spot for gold to potentially turn uber bullish. Now shorter term, I actually think that you could see a bounce right here. It's about 1171, 1172. That is based on the bigger slope here, and this is arithmetic scale, but you can see the levels that provided, extend off here, and off here, with the most significant action taking place earlier this year in January. Resistance went through it to breakout. It was actually resistance here on one day. Okay, so you could see something of a snapback, if you will, on gold at 1170. If you did, your natural resistance point here is 1200. That's very simple. It's just the low from May 30th. Okay, so 1170, 1200, the 2 points to trade, in my opinion, in gold. And that, that's probably over the next couple of days. Would not expect it to be over, the next day, considering that we are going into the holiday, and we've already seen a great amount of volatility and moves just today. I know sometimes you do see substantial moves. Actually, it can be even on Thanksgiving, as U.S. markets are closed, but other markets are not. And thin liquidity, sometimes you get exacerbated moves. In my experience, that actually happens more so when the market that you're looking at, the market in question, actually has been fairly quiet, right? And then you get these kind of surprise moves on Thanksgiving or around then. Well, needless to say, the markets haven't really been quiet lately, so I'm not sure that there will be a lot to push through tomorrow. Everything that's done might have already been done, is what I'm kind of getting at here. So I would pay attention to this, but maybe not until Friday at the earliest, and probably more so next week. But again, you want to have those marked down: 1170, 1172, and 1200 for gold. And it's a good time to look at silver, since we're looking at gold. Canwall asking silver, please, resistance and support, and then looking at crude, no doubt. Let's take a look. So silver is dumped through everything on this structure. Okay, there's really nothing left here. So bye-bye. Let's go to the weekly chart. Log chart it is, and again, nothing here either. Get rid of that. So again, we're back to essentially this long-term, resistance channel line, which is drawn off the closes, if you remember. Okay, I'd be looking to that level on silver. I don't have anything here drawn on the bear side, but I'm assuming we can put something in there. Let's go to a 4-hour chart here. First thing you want to do, or what I do, is I go off the first two highs. okay? And then you can draw parallels from that point. See if you get anything good. Already gone through everything. Okay, so in this case, silver 1650 is the former support channel, which was support actually on the 14th, so last week. That was support. So 1650 would be the level that needs to be overcome to have any sort of positive look on silver. And we go with this one, which is a little steeper, and see if there's anything good there. Not really. You're already through that as well. I have a feeling here, Canwall, that silver might be one of those markets at the moment that really is not worthy of an opinion. Right? And what I mean by that is that sometimes the market just really is not clean at all, and you don't want to force an opinion on the market. Like, I can tell you that if I'm looking at a market, it will not take long but a few minutes for me to know if there's something there for me or not, at least the way I look at it. And in this case, I really don't see anything, and it does not make any sense. It does more harm than good to force an opinion on the market. This is about the only thing I would watch on silver. This is a 4-hour chart. Potential channel down here, okay? This is iffy. You have really no touch points here. You do have some horizontal levels to work with. It's a good cluster of stuff between the October high from 2015 and the June low from this year, which is 1580. So I would kind of watch this line and watch 1580. All right. That might be something that gives you, some sort of capitulation low down here. Obviously, intraday volatility here, folks, but as I'm speaking, it does look like dollar yen's about 60 pips off the high already from today. Obviously, quite early to call the capitulation already, but remember, 1206 is the high volume level. So if you get below there, start to really think actually about getting some sort of bigger reversal. The thing with silver that's a little more difficult to deal with, from my experience, is that you obviously have the percent moves are so much larger that you have to toggle between charts for log scale and charts for arithmetic scale, right? What you see on one is not going to be nearly similar to what you see on the other. This could be something to watch, actually, Canwall. This is a weekly chart. Log scale, arithmetic scale. Arithmetic scale puts support about 1581. Log scale puts support about 1563. So it all points to basically a test of the May 30th low in silver, at which point you could get something exciting on the upside. Okay, so I would follow this here. And let's draw it in on this chart as well, on the daily. Yeah, Nicholas saying, what about euro? Yeah, you might have been a wee bit late here in joining, but yeah, what did we write all week about euro? Right, we said 104, 60, 70 resistance, 106, 60-70 resistance. We did get that resistance up here yesterday, 106.57 in Europe. And we said one more low, at which point we may reverse. And here we are, one more low, and thus far we have responded to the one more low idea. Again, your high volume level is 105.56. So you get a nice bump here, a show of strength. The next dip would be the one that you would want to buy in euro, right? In this case, you could end up being long with a 40 pip stop and target, several hundred pips on the upside. That's certainly a possibility. Okay, moving along. We were just looking at silver. Let's go back to it real quickly. Okay, so this might be something to follow along with Canwall, this silver chart. Okay. You can see the log chart. You see the 25% line being support here on May 31st. That level on a horizontal basis comes in down here. Okay, a little more puke, your big support. If you bounce, guess what? That same line is going to more or less intersect with the low that you had back here in October, very close to 17 bucks. So the gold chart is a bit cleaner from my vantage point. Again, 1170s, low 1170s for a capitulation potentially. 1200 for resistance. 1120 for major capitulation on gold. Okay. Silver 17 bucks for some resistance, maybe 1580 or so, maybe a little lower, 1563 for some support. All right, so the metals, we've taken a nice look there. Eileen, quick question here. Absolutely. She's got what's the difference with log versus other scale charts? So log scale is just percentage based. So something that moves substantially, for example, Bitcoin. Okay. Bitcoin has gone, you're looking at on this chart here. If we're looking back, you're looking at this chart from $2 up to $1,200. Okay, that's not very, that's a massive move. If you change it to arithmetic scale, it looks like this. In other words, each increment in price is going to be treated the same. Okay, whereas log scale, it does not treat each increment in price the same. In other words, going from 1 to 2 is like going from 50 to 100, right? It's a percentage base move. So if you're looking at a very long-term chart of something that moves substantially, like any stock chart for that matter, you're going to need to look at a log scale. For currencies, it really doesn't matter a whole lot because they don't really move that much, right? If you're looking at something like the Mexican peso on a long-term scale, then yeah, because they've had revaluations and whatnot. But for the most part, intraday, you're never going to need to worry about it. But if you're looking at longer-term charts, it's something to consider. Something like silver, which moves substantially percentage-wise, is going to be quite different as well. Okay. Alrighty, where were we? Canwall. My man wants crude. You got it. All right, let's look at crude. Crude oil. So if we scroll out here, the level I had some crude charts in the update last night. We came into a really big spot. Okay, the 49 area in crude oil is significant. You do have the high up there from August 21st. Let's look out a bit just to start with this here. Let's see here, crude oil. I'll go down here. All right. Really, 49, as you can see, big level, going all the way back really to August of 2015. You've seen some big kind of pivots around that region, and the key reversal we saw yesterday in crude to me, I'm looking lower here, okay, from this point. And if I look at the short-term chart, is there some slope that we could pay attention to? Of course. The first area to pay attention to on crude is probably going to be about $47. $47 is where you get the 25 line, and the reason to look at the 25 line is because the 75 line is essentially where you found resistance just yesterday. Okay, so that's an area to watch for in crude oil, is the 47 region. So look lower from here, but with 47 as potential support, which again is $1 lower than where you are right now. So you could see something of a a decent move lower. $1 move in crude, as we know, can happen in the blink of an eye, especially in this environment with all these headlines about OPEC meeting and cutting or not cutting and people agreeing or not agreeing, right? But $47 looks like your spot as a short-term trader, Canwall. Now, bigger picture with crude, look, everything from basically August, right? You got this, well, even longer than that, I should say. Everything since the high back in June. We failed there twice, all right? It's not a double top until it's a double top, which means it's not a double top, so you break 39 bucks. I don't think that actually happens. Because there are reasons to be much more positive on a longer term basis on crude, notably the analog that goes all the way back. We're following here the 1990s period, which lines up extraordinarily well, right? It's this period right here. That's the period that we're looking at, okay? And we've overlaid it. So I don't think we get back down to 30. I do think that you can start to take off at some point in a few weeks, because that's when the next analog low is due in this. But you can see the big turns have been identified, within several weeks of this, including the low back in February, including the high back in April of 2014. All right. So with crude, what that leaves us is I think it leaves us with basically treating everything from June as a consolidation. So, an A, a B, maybe you get A, B, C, maybe you get a test back here of the low in in November, right? A, B, C. So one more leg down, right? Fake the head and shoulders, start to move higher. So the takeaway here from a trader's perspective is that there's plenty of downside potential. Short-term basis, I'd watch 47 bucks. Okay. If you do go higher for one more high, you would have 5 waves up, in which case you'd be looking lower again anyway. And then don't forget, I put that chart up yesterday, which showed, going 10% higher in 5 days, right? A 10% move in 5 days is quite rare, actually, for crude oil. And really don't have a whole lot of them. You have had more, obviously, since the low back in January of 2015, because you do get very strong counter trend moves higher. But since that point, the magenta dots are 10% up in 5 days. They have tended to mark, at least interim tops where you fall for several days. In some cases, more important peaks. All right, so whether or not you go above yesterday's high, to me, the risk for at least several days and perhaps several weeks is to the downside in crude oil. So I do hope that helps, Canwall. Your levels to mark down really are simply 47 bucks on the near term, and understand that if you do go to a new high, I'd still be wanting to fade it and sell it, for kind of a mean reversion trade, because that's what the statistics here say, and the levels line up well, or also line up quite well. All right, so moving on, let's look at some things that actually have been working out well. The Kiwi idea. Okay, so here's Kiwi, and let's look at a few different things here. Okay, well, to clean it up here, I'll kind of go from scratch so you know exactly where all these things are coming from. So you have essentially a year-long uptrend, right? This is January, and you moved higher. I mean, it's pretty choppy, telling me that the structure is inherently weak, and that you're going to see, you know, a decent down move here in Kiwi. All right, so this trend line, again, here's your original trend line, yeah? Well, that happens to be the exact same as the neckline that we just broke. Okay, and the fact that we are, you know, finding resistance on that line the last 2 days is quite promising for downside resumption. So, new bearish. You see all this resistance that you had the last, and this is a good lesson, I think, in you know, understanding forks and when to use them, or you know, when to, you can, as I say often, anyone can sit here and draw, you know, a pitchfork, right? It's understanding when it's useful or not. And in this case, you draw, you know, with the high, you got a nice high, low, high. That's what you need, 3 points, right? Well, you draw it, you really don't have any reason to suspect that this is anything important until the last 2 days. Why? Because you can see that the median line has been acting as resistance, right? It acted as resistance back here on the 16th and 17th, but then it did so again yesterday and today. Okay, so 4 touches on this as resistance tells you that this is, you know, something the market is paying attention to. So we're going to pay attention to it as well. And, you know I have the target for this around 68.30, which is, you know, a couple ticks above the, you know, the year open price. I do think that you could get all the way down, however, into a test of the May low. Okay, I think that is a possibility. If that were to happen, you would have an intersection. It wouldn't be for another month. All right, you have the intersection of the May low, the trend line here, and the new lower parallel. It all lines up down here at 66.75. All right, so keep that in the back of your mind as we move forward with Kiwi dollar. Kiwi dollar could have significant downside potential over the next month. And the most important question, you know, that should be answered is, where's the risk for that trade? It's really just above yesterday's high, which is, you know, 70.85. So we're already short from pretty close to up there. There's really very little risk here. We're, you know, talking about on our stop right now, we're talking about having 25 pips or so of risk and really good downside, about 20 times that. Okay. So this is a good, I think, a good, you know, combination really of looking at, you know, classical chart patterns, right? You do have the head and shoulders potential, but also with slope, right? This neckline is more important to me than just any other neckline because it's the same slope or the same trend line as the trend line that goes all off the original lows back here from last summer or 2 summers ago, okay? August of 2015. So that's a biggie. I really do like the Kiwi setup, the Kiwi idea. And that plays into, of course, and Canwall's asking about pound yen. We will certainly take a look, my friend. Let's hold on just one moment. It certainly plays into the Aussie Kiwi idea. Aussie dollar itself, we'd written about, 74.40 last night. Beautiful touch on that level last night. 74.44 is the high. Again, that is slope. It's also, most importantly, the September 2016 low. So here we have that. And if we take a gander at the daily chart, go through this exercise again, draw it up for you. If this is wave one or A in a major new bull market in Aussie, might we go A, B, C, which means that you have to drop below 71.45 before Aussie can really make a low, right? Two equal legs gets you 70.88 right on this level. So you can see here the low, just tagged it today. Tomorrow being Thanksgiving, I'm not going to be putting any orders in tonight myself, but I would be looking at, given this, the reward to risk proposition on the downside is actually promising, really against today's high, 74.45. With the added caveat that you could have widening spreads. That's something you have to think about. You could have widening spreads and stops could get taken out that otherwise really shouldn't be touched with the holidays. So just bear that in mind. But I do like Aussie itself a little bit lower to complete what could be a correction that really started in April. So here's the hourly chart. We've already come into resistance. I wouldn't risk anything on the short side over today's high, which again, 74.44. So maybe put stops above 74.50. Resistance 74.13 or so. It's actually the high from yesterday, in which case you could look to take Aussie lower again. Okay, so that's a good setup there as well. Am certainly more bearish Kiwi than I am Aussie, right? And that, of course, has to do with the fact that Aussie Kiwi itself may finally be trying to make good on its long-term bottoming potential, that we've been talking about for what seems like most of my life, but in reality, it has not been most of my life. So again, we bottomed yesterday, put a chart up here last night. We bottomed on a parallel. We've turned up sharply. You did have a key reversal yesterday. It was not, a J spike. The reason it wasn't actually is because you didn't have a 20-day low. It was a 19-day low. So kind of semantics there, but you are following through on the upside. And this, by the way, this candle pattern in which you open at the low and close at the high would be called a tweezer bottom. Okay, they're more common on weekly charts. In fact, we saw some earlier this year in the Aussie dollar, if you recall, back in January. But we did have a tweezer bottom in this yesterday. Again, this just gives me a little more confidence, if you will, in Kiwi on the downside. Maybe not necessarily being totally long Aussie Kiwi yet, but just being more short Kiwi than Aussie against the dollar. So there you have that. Let's see what the short-term chart looks like, 60 minutes. Not a totally clean impulse at this point, but we'll just keep this, kind of on mind. The big move is going to happen once you break through trend line, right? And 106.60, the year open. Okay, what about dollar CAD? We looked at dollar CAD last night. I didn't have this last night. I had the little circles on here. I had one here looking for a new high and then a pullback. Instead, we just got a pullback and went ripping higher. You have so far pulled back from just above the weekly opening price, 34.60s. This is basically your support. Again, you might have a 1, 2, 3, 4 extended 5. So it's not inconceivable that you do get a pullback all the way back into near the month open of 34.06, 34.23, high volume level from NFP. Is that still the high volume level from NFP? It is. Dollar CAD, interestingly, actually hasn't made any high volume level since NFP. So here's the NFP high volume level. You can see that level at times has been pretty solid. right? And this is, you're going to be looking at CAD futures here, so it's a bit different, but the level's been kind of spot on at times as far as potential for just really solid rebounds off of it. So again, that would be a level to put orders at or buy into if you got an intraday decline. 134.20. The risk is tight on this. Okay, you're talking about 33.70 as far as a stop. I still think potential for us to get to 138 in dollar CAD. Okay, and the way that's we declined in 3 waves here. That's a corrective process, and the two motive legs within it are nearly identical, right? You have A, B, C. They're miss equality by 2 pips, and then you've got good solid impulsive strength on the upside. So I do still like dollar CAD higher. And now we can get Canwall to pound yen. So pound yen, pretty nuts. You had what? I guess a respite of strength yesterday with a small range, and here we are now trading all the way up into the highs that were seen in July. We're back to the Brexit close, actually above it, which was 139.57. This Canwall is the slope that I'm following as far as the bullish slope. Okay, and that is, you can see the median line here. That is the level you're going to want to watch for support. I know it seems like a pipe dream to say that pound yen or any of these yen crosses can reverse, even for several days, but they will. Okay, and when they do, the declines will be sharp. It'll feel awfully sharp. It'll feel like the big top is in, when in reality, it may just be a dip, in which case you'd be looking for, I think, median line support on this in pound yen below 137. Okay. You are getting to the 75 line. It is a possibility that you could fail up here at about 140.50. I would not, even with anybody else's money, take a short on this, given the extreme kind of upside momentum that you have. And there's also the pound variable, right? Dollar yen would be a little more interesting to me than pound yen. Pound is holding up extremely well in the face of the dollar strength. There's a relative strength story there, obviously, with pound dollar, as you can see here. Even if pound dollar isn't going to go into a screaming bull market, I still think you have the potential trade up into 25.90, 126. 126 is daily reversal resistance, right? 11.11 close. And then, of course, it's also the long-term resistance line in red, which is, at the end of the day, just the bottom of the channel, right? Which we ran into a couple weeks ago. Yeah, envisioning, a pullback in pound yen and yen crosses in general is, keep saying that potential is there, but, just when you give up on it is probably when it happens. And then we'll, look to analyze how that weakness plays out. But we are essentially there with dollar yen, so probably most yen crosses, right? Early in the webinar, we went through 113, how big that was on a long-term basis in dollar yen. We went through the extreme 20-day range size, the extreme 20-day volatility reading. Historically has indicated that you've been at risk of a pretty sharp mean reversion move in dollar yen. Obviously, if it happens in dollar yen, it's going to happen in the other yen crosses as well. So, bear that in mind. And, with stuff like this, I would, urge you to kind of keep an eye. It's easy on the short-term charts, as I said before, to get, kind of emotional and out of sorts, and you start seeing a move and you want to chase it, or you want to fade it immediately where you don't even really know if you're at a big level. Keep this front and center, right? This is a big spot. When you have this a chart like this weekly chart up, you know that, man, 113, this is a big, big spot, right? So, wait for a day. If you get some sort of a key reversal day or whatever, you have something to work with. Wait for a move under 112. 112.06 is the high volume level, rather than saying I'm trying to pick the exact top and be the smartest guy in the room, the hero, whatever, right? There will be times when that does pay. It's few and far between, and really at the end of the day, it's kind of going to be based on nothing more than you got really, really damn lucky. So that's how I'm going to approach dollar yen moving forward. Under 112.06, fine. Look to take some downside. Until then, kind of going to look at this thing and observe it and wait. So that's that. Any other questions I'd love to answer, let me know. And if there are, we'll go through the charts. Oh, Canwall, you're quite ready, my friend. Yes. Precious analysis. I like that. Thank you. Canwall, you're the man. Okay, Pooja, Matthew, we want to look at S&Ps. We want to look at Euro Kiwi. Let's take a look. I can tell you right now, Euro Kiwi is an interesting proposition given the potential for a Euro bounce and kind of being pretty bearish on Kiwi, right? So I don't know about major bottom. Again, I'd rather be short Kiwi dollar than long Euro Kiwi and take a Euro long for a bounce if it's indeed going to work. I'm not saying that the Euro low that you make here is going to be significant. There's not any evidence to say that at this point. I think that you could remember the stats from this week, for last week. We were thinking that you get a bounce for a week and then you go lower again. That's what the stats bear out. So I wouldn't get too, significantly bulled up. Can you rally 200 pips from the low? Yeah. But are you going into a really long-term bull market in Euro? At this point, this may be me capitulating, but look, at this point, you kind of broken through everything. The 30-plus year trend line is not holding anymore. I have no reason to be a long-term Euro bull until things really reset themselves. So let's look at Euro Kiwi though, and then we'll look at the S&P. All right, Euro Kiwi. Not sure why this is not loading, but bear with me. Okay. So the channel that we looked at here, because I remember drawing this in maybe several webinars ago, we did look at this channel and maybe looking for channel support on this, but you did turn up, again, this was the election, right? So we did turn up, and I'm measuring from here, right? The 11.9 low to the 11.11 high. So I'm not measuring off of this high. Again, measuring off those spikes highs, usually not the best thing in the world. For trend lines as well, it just simply is not a place where the market really traded, right? It's very thin. You don't really know, if the price is right or not, because different platforms have different prices. So draw off the next level. Anyway, doing that gives you actually the 618 that we bottomed at yesterday. So can I say that Euro Kiwi is a massive bull right here? I can't, because I don't see, the pattern has not formed that would say you can go launch into the stratosphere. But there has been a market, or there has been a short-term opportunity here with the 618. So yeah, I would be looking at, seeing support here. Okay. I will show you two equal legs down from the high, and again, measuring off the succeeding high from September 2015, not August. Okay, so you have that going for you, and you have divergence on the weekly chart. Now, divergence at times has indicated some pretty big turns here. Lows back here in January 2011. Again, that's the RSI divergence, and with, of course, the condition that RSI must be above 35 or below 65. So you can see that you had some pretty good ones. Here you went up 2,000 pips in about 2 months, 3,000 pips. Back here you had a top. It took a couple readings. Very minor bounce here in the grand scheme of things. And then, of course, there's some that just don't work at all. So, this would be something to pay attention to as far as if you're going to get, a bigger bounce, if this divergence is really going to work. Maybe you want to put something on here because you have the 618 and you're holding 150. But if you start to get, you start to really get moving higher, it might be something where you want to look at identifying a shorter term bullish slope to work with. So certainly see the potential, Matthew, in Euro Kiwi, and it's potentially forming a major bottom. I just can't say that it's the best thing out there at this point. But you have the levels there, you got the divergence there, the momentum. I would still stick with, still early, absolutely, still early, totally, right? I would stick with trading Kiwi on the short side against US dollar at this point. And Pooja wants to see the S&Ps. Here we are. I think we had this exact chart, the long-term chart, in the update several days ago. We are getting really close to the long-term Fibonacci projection that I have written on the blackboard to the left of me, and it's been there for a long time. And let's see, 2,300. All right. If you take an extension, March low, 2009, May 2011 high, October 2011 low, you get the 1618 at 2213.50. That is really close to the parallels that extend off the highs from 2014 and 2015. And it puts you just about 2215 to 2230 or so. So here we are at 2200 right now. High so far is 2203 in the cash index. So yeah, you're getting really close to what could be one of the biggest inflection points in the history of the stock market. I don't say that lightly. I don't think I've ever said that on this during these webinars. And you remember we talked about the potential for this thing to end with the ending diagonal. Seems to be what we're getting. Right? 1, 2, 3, 4, 5. So do watch the ending diagonal. This one, you can see how it more or less channels, right? Where a lot of ending diagonals, you get more of a wedge, right? So you get something more like that. The fact that it more or less channels actually tells you that this is a very weak structure because there was more selling pressure down on a wave 4. Now, of course, if we look at the futures, you know how much lower you went, right? Because the election spike. So you're not even seeing that on the S&Ps. On the regular trading hours S&P on the cash index. So, you could look, textbook says that Sometimes with an ending diagonal, you get all the way up to the 1-3 line, which would put you way up here. I actually think that you're going to get more of a reaction or a top before then with these long-term parallels. Okay, I mean, these cross through all the tops from back in 2015, late 2014, and this year, which was back in August. Okay, so that's 22.15, 22.30. Let's see if we can look at something on the short-term picture, see if there's any discernible pattern here. So this is S&P futures, right? There's your election move. And since then, it's really just been a very tight channel, right? Kind of like dollar yen, except dollar yen recently, today, has gone, kind of vertical, and you're not seeing that in the S&Ps, which are completely flat right now. So still, watch this line here, right? In fact, this line in conjunction with the longer term ones is up in that 22.25, 22.30 region. I mean, that's kind of a sweet spot. Tactically, this line right here, this is your support line for the last 3 weeks or so, last 2 weeks, I should say. If you break below that, that's really your first behavior change that you would have had on the S&Ps since this entire election thing started. Okay, and that would be the first time that you could say, well, maybe the S&Ps are actually going to go lower. Let's look at the cash index. It's going to look quite different. So this is the cash index, right? You don't have all of this down here because you didn't have, it's the futures. So with cash, I'd say this is probably, and this might end up as a diagonal 1, 2, 3, 4, 5. This is clearly a 1, right? 1, 2, 3, 4, 5. This is clearly a 2. And then here you are rallying in slight impulsive fashion. So what I think is probably going to happen is that you're going to get one dip, you're going to hold support, and then you're going to go to another high. 1, 2, 3, 4, 5. Okay. With most of the move obviously coming on the day after the election and the day after, or the day of and the day after the election. All this. Okay, so with S&P cash, which is your index, pretty much be looking at 2180 or so as resist or as support, excuse me. And not changing my mind, obviously, on the resistance, area here. You can probably use these levels as well. It would be about the center. The median line would be right about there. Yeah, so I would pay, so this is where you want to pay attention to. Anyone trading S&Ps or that wants to get a better sense of the S&Ps, where they may be headed. This area right here. Okay. Inflection points, inflection points, inflection points. Watch this line, Puja and everybody else. Okay, that would be your new support. Okay. Oh, Puja, thank you so much. Puja loves the precision. Awesome, super. Eileen, you are absolutely welcome. She just says it sounds like you have a good crowd visiting your place. It should be fun. Yeah, I think so. Nothing like family on Thanksgiving, right? So yeah, thankful for that. I'm thankful for all of you. Thankful for you guys attending the webinars and being with us and being with Mike and I as we go through this journey, right? And Henry says NFL games. You got it. Mike doesn't like football very much, but I will be certainly. But he's laughing. But I will be watching the NFL games myself. He can go talk to the wives, the women, and the wives, or something. I don't know. So yeah, no doubt about it. But yeah, thank you very much, everybody, for the kind words, and we'll be back with. We'll have an update tonight. I will, and I might put out something on Friday. If you recall, last year we actually put out the special report, which had to do with it was IDO search stuff on Euro. And we're seeing some of the same setups right now in some of these Euro crosses. So we might put something up Friday as well. But in any case, we'll have this webinar archived and up for viewing here just when it's finished processing. And happy Thanksgiving, everybody. All right. So take care, and I'll talk to you later. All right. Bye.